Let's talk about minimizing tax traps. This is the second step that you need to take if you're leaving your tech job. The first thing to do here is to understand the tax implications. As I mentioned, equity compensation can be pretty complicated because each type of equity compensation has its own tax implication. The way RSUs are taxed are so different from how ESPP stocks are taxed. So you have to understand what is the difference there. Restricted stock units are basically taxed as income taxes when they vest, and then when you sell the stock, you will have a capital gains depending on how long you held on to the stock. ESPP stocks, on the other hand, it really depends on the grant date and the purchase date. They can be taxed as income or as capital gains. So you have to be really careful about that. Stock options, depending on what it is. If it's an incentive stock options, it can be all capital gains if you meet those holding criteria. Then your non-qualified stock options are taxed partly as income and then partly as capital gains tax. So you need to really understand the tax implication of each type of equity compensation you have. The second thing to do is to plan for your taxes before you exercise or sell your stock. Now, the way we work with clients is that we get the tax returns from the client before we have them sell the stock, and then we do a tax projection to see how selling the stock and exercising will affect their taxes. We actually had a client recently who came to us after he sold his incentive stock options. He used to work for a startup, and there was an opportunity in his startup to sell his private company incentive stock options in the private market. And as a result of the sale, he was able to get $600,000 in proceeds of the sale. However, because he didn't have an advisor, he didn't know that you could get a more favorable tax treatment in incentive stock options if you held on to the share and you sold it 2 years from grant date and 1 year from exercise date. So he sold everything all at once, so he had a disqualifying disposition. And because he didn't know how much taxes he would owe, he was holding the entire $600,000 in proceeds in idle cash, waiting for April 15 of next year. So when he came to us, we got his tax returns from the previous year, and then we showed him how much tax he would owe given how much he had exercised and sold. And then we helped him reduce that tax by, first of all, increasing his 401k contribution. He was only contributing to a Roth 401k account. So we changed that completely and switched him to a traditional 401k, which would reduce his taxable income, which is what we want which is what we want in order to reduce his taxes as well. The second thing we did was start a donor advised fund for him and contribute appreciated stocks there so that his taxes would come down again. With all of these moves that we did, we were able to bring down his taxes by almost $100,000. And then after we knew what the total tax was that he owed, we kept that money aside in cash for him to pay his taxes next year. And then the rest of the cash we invested for him in the market. So that way he was able to get the return on his investment and not just sit on cash the whole time. Now, if you are in a similar position as him, where you have a liquidity event where you're able to sell your private company shares, or you just have RSUs or ESPP stocks sitting in your account and you want to sell them, it's really important for you to speak with an advisor before you sell anything in order to understand what the tax implication would be and how to minimize and potentially spread that tax across several years so you're not hit with a huge tax bill in the same year.